So Mark has materials for all three levels of the CFA exam, and I used his materials for all three levels, and it helped me out a lot. But I was checking on his website that now he's got this applied series for the CFA, which is related to, I think, options trading. But that's one part of your package on your website I wasn't super familiar with, and maybe there's other people. So I was wondering if you could talk about that a little bit.
The applied series?
Mm-hmm.
Yeah, it started off as just options, applied options, and then it morphed from there because I thought, well, there's a lot of other parts of the CFA curriculum that um, are textbooky. Once you read it, you think, okay, well, I get that, and if I put you in front of a screen and say, okay, well, off you go now, you wouldn't know what to do. It would be difficult.
Totally.
So if I said, buy, let's do a carry trade. Let's get some yen because that's really cheap to get, and let's buy a Mexican bond. And do you want to hedge out the currency at that point? Okay, well, we understand what a carry trade is from level 3. We understand what an intermarket carry trade is. You're using one yield curve off against another, but now actually do it. So it's the application of it that's missing. So I thought, well,
Yeah,
why not go a little bit deeper than what the book says and say, well, here's how we do these things. If you're running a portfolio, here are things that are just not mentioned.
sure.
You've got to watch out for this. You got to be careful for that. Where does your risk lie? It lies here. It lies there. I feel that they underutilize the options as a risk management tool for your portfolio. I think they overemphasize expected return and they underemphasize volatility. And I think portfolios should be managed volatility first. Return will be what return will be. It is the most difficult thing to forecast. What is more stable is volatility. So if you look at General Motors stock, I mean, it's been all over the place. But if you look at its volatility over different periods of time, the volatility has been fairly stable. The realized volatility, even though implied volatility can move up and down, the realized volatility of returns has been fairly stable. Whether you use a 3-year look back period, 5-year, 10-year, daily, weekly, monthly, it's been fairly stable. But return, well, who knows what return is going to be? So when you start to realize that it's easier to forecast the realized volatility going forward, why not manage that? Why not manage
Mm-hmm.
a portfolio of volatilities and return will take care of itself? Well, the best risk management tool out there for managing that volatility is the options, because you can sell and buy only the parts of the distribution of returns that you want. So it started with that. Then it went into sector studies, and I thought, how many times am I asked, like, how do you know this, or how do you know that, or how do you get to know this? And it's just experience over time. So I thought I would, collect as much information on each of the sectors as possible.
Sure.
Uh,
And when
I
you're showing people how to execute these trades, is there a particular trading software that you generally recommend to people?
I use Interactive Brokers only because there are no limitations. It's unless it's OTC, then you need a dealer, right? Um, that's assuming that you could be a decent enough counterparty as a retail investor to go OTC. But every market in the world, every exchange in the world, you have access to every asset class all on one platform. So I can do Forex. I can hold multiple currencies in the portfolio. I can do options. I can do bonds to the extent that they're listed on the platform, mostly treasuries. I can buy Japanese stocks, Mexican stocks, German stocks. I can trade futures on any exchange you want at the lowest transaction costs that you're going to get as a retail trader. Um, don't look
And
for customer service though. That's one thing they give up
mhm.
on. Is if you got a problem with Interactive Brokers, you're pretty much on your own, because you call them up. The first thing they do is they place blame squarely on you, and they don't move forward until you accept that it was your fault. And then sometimes they just hang up on you once they say, "Oh, okay, so it's your fault. See you later." I mean, I'm not kidding you. It is. The
That's so
worst,
funny.
the worst customer service.
They got a call center somewhere where they give them a script, and the whole script is just how to lecture the customer.
Yeah, yeah, yeah. Deny any responsibility. Step one. Step two, place blame firmly on the customer. Step three, hang up. That's that's the script. I can't tell you how many times you start with a problem and they just get rude with you. They basically call you stupid and dumb, and then it's like I can't believe. But yeah, anybody listening who's been with Interactive Brokers, I'm sure has a customer service horror story of their own. However,
Oh,
if you can get
yeah.
past all of that, it is one platform where you can get everything done, a whole
Mhm.
portfolio all in one place. So
Well,
I use Interactive Brokers.
you just gave me an idea. I think if I ever need an ego check, I'm just gonna call them up just to take me down a few notches.
Yeah, 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 yeah. So yeah, it's unfortunate, but I can't find another platform that gives me the information and the power and the resources that I have and the customizability that I have than Interactive Brokers. And I don't even use most of their features, so I haven't even begun to explore
Mhm.
all that they have to offer. But I do it through that. I introduced, and I thought, well, there's futures that can be used. And options on futures. Now, options on futures are different than options on stock because you have to worry about, well, which underlying do you have? If I sell options on GM, I don't have to worry. The underlying is GM. But if I sell options on the S&P 500 futures, which futures contract am I selling options on? So you have to have the right underlying, and they get illiquid very quickly once you start going out more than 3-4 months at a time. Same with treasuries. You have to worry not only about the underlying, but on the underlying, what is the cheapest to deliver? What do I really have? Do I have an 8-year bond underlying the 10-year? Do I have a 7-year or a 6-year? Because the movement on the curve is going to tell me where I want to be. Do I want to be in the 5-year instead of the 10-year? Do I want to be in the 30 instead of the 10 because I need duration? I'm going to be introducing currencies as well. They're brutally difficult to forecast, but in trading them, how would you do it?
What makes them more difficult to forecast than other asset classes?
Random walk. In the long run, relative purchasing power parity seems to be about the best as a long run mean reverting level. So when they move away from the relative purchasing power parity, it could signify either a short position or a long position. But a currency can move in one direction to the point where it breaks you before it returns to relative purchasing power parity. In the short run, it's primarily driven by the expectation of interest rate and inflation differentials, more so interest rate differentials. But you take the period from 2011 to 2020, when central banks weren't doing a damn thing. Currencies were flip a coin. Who the hell knows where they're going to go next? I mean, flip a coin, because there really wasn't much other than other than potential for growth or foreign direct investment. But beyond that, it was, for the developed currencies, do you want the pound, the euro, the Canadian, the US? I don't know. Flip a coin. So they're notoriously difficult to forecast because there's no balance sheet. Um, Trade flows don't really do very much. Capital flows matter, but if interest rate differentials are going to be unchanged for years at a time, well, at some point the currency gets to the point where the risk adjusted return is gone. So now when you combine that with, if you have a subscription on our site, if you have the level 1 plus or the level 2 plus or the level 3 plus, which means it comes bundled with the applied series, August 15th or in around August 15th starts the portfolio construction applied module. So if you're at level 1, you're going to see Python, you're going to see financial modeling with CFA, and you're going to see how you build and maintain a portfolio from scratch. How would you start?
Mhm.
Well, you start with your screens. What screens do you need? You need treasuries, you need Forex, you need commodities, you need energy, you need your stock watch list, you need your your key markers. So let's set
Mm-hmm.
up our trading platform first so that we have our information coming in. Then you make decisions. Well, what allocation to equities, what allocation to fixed income? How are we going to get these allocations? How are we going to get this exposure? And fixed income, are we going to be high on duration? Do we have a cash rate? What's our forecast for where the central bank is going? If rates are going up, let's have some cash allocation and some duration. If rates are going down, let's get out of cash and move. So you have those capital market forecasts that will come in. So it's a lot of all of the thinking brought down into, every week we introduce one little extra bit of incremental difficulty so that in 6 months' time, you're running a balanced portfolio, where your rebalancing points are. And hopefully we will be able to break most retail traders of the terrible, terrible habit of their hands on the keyboard.